Hi, welcome to the Crypto Republic. Before we begin today, if you're serious about staying ahead in this once-in-a-lifetime financial shift, make sure you like this video, drop a comment, and subscribe to the Crypto Republic. Hello, XRP Army, and welcome back to the Crypto Republic, your go-to channel for the latest energy updates and digital assets. Before we get started with today's business, make sure to smash that like button, ring that bell, and subscribe to the Crypto Republic, bringing you updates every day at 9 a.m., noon, and 7 p.m. Eastern Standard Time. And here at the Crypto Republic, we give you the bird's eye view, a satellite perspective to spot the big picture shifts while everyone else is stuck in daily chaos. Just a reminder, this video is for educational purposes only. This is not financial advice. Always do your own research before making any investment decisions. Something just happened with XRP, and most people did not catch what actually matters. A date surfaced, not hype, not noise, a timeline. And if you've been in this market long enough, you already know something important. Markets usually do not move when the crowd feels ready. They move when the structure underneath starts to change. So the real question is not just what this date means for XRP. The real question is what happens when timing, regulation, and institutional positioning start lining up at that same moment. Because if that's what we are looking at here, then this may be a lot bigger than one headline. Ladies and gentlemen, welcome back. If you're here, you're probably not just watching candles. You're trying to understand what is changing underneath the market. Because short-term noise, long-term structure. And right now, something is building. Not just on a chart, not just in social media chatter, but deeper in the legal, institutional, and financial framework around crypto. This is why this matters. Because for years, XRP has lived in a very specific kind of market environment. Uncertainty, debate, delay, and constant second guessing. But now, a timeline is starting to come into view. And when a timeline appears in a market that's been stuck in uncertainty, people need to pay attention. Not because anything is guaranteed, but because moments like that can tell you the environment is changing before price fully reflects it. And that's where this gets interesting. This may not just be about XRP reacting. It may be about the system around it starting to shift. I just want to say thank you to everyone that takes the time to stop, like, subscribe, share, and comment on these videos. These few things really do help us out very much, and the channel grow very much. And with that being said, let's break it down. I hope you enjoy the content. Let's zoom out for a second, because what we're seeing right now in crypto is not random. It's a transition. For years, the market's been driven by speculation, fast money, hype cycles, retail chasing momentum. But now we're starting to see something different, a shift from speculation to structure, hype to infrastructure, retail to institutions. And historically, this is where things get interesting. Think about the early internet. In the 90s, it was chaos, thousands of companies, massive hype, no clear regulation. Then what happened? Rules came in, standards formed, infrastructure matured, and the companies that survived that phase, they didn't just grow. They became the backbone of the modern economy. But here's where it gets interesting. Crypto is going through the exact same phase right now, and XRP is sitting right in the middle of it. Because recently, Brad Garlinghouse came out and made something very clear. And over a decade of fighting of regulatory clarity, he confirmed that we are now closer than ever. And this wasn't just talk. We're seeing meetings in Washington, D.C. with lawmakers like Tim Scott. Let that sink in. This is not a crypto project asking for permission. This is a company actively involved in shaping the rules. And this is what most investors are missing. There's a massive difference between reacting to regulation and helping write it. And right now, Ripple is positioned on the second side. Now, at the same time, the market's giving mixed signals. Bitcoin is strong. Altcoins are rotating. Some small tokens are even exploding, 5, 10, even 20x. And XRP, still relatively quiet. Now, this part surprised many people because this is exactly where most investors get it completely wrong. They chase movement instead of understanding timing. Let's be honest. When people see a token go from cents to dollars overnight, they feel like they're missing out. They jump in late. They buy the top. And then reality hits. This is one of those oldest patterns in the markets. Fast pumps, emotional entries, and sharp corrections. Now compare that to something like XRP. No explosive moves right now. No hype frenzy. But underneath, you have regulatory positioning, institutional alignment, real-world financial integration. Price is reacting. The system is evolving. And here's the key. Institutions do not move based on hype. Let that sink in, ladies and gentlemen. They move based on compliance, clarity, risk management. For years, the clarity didn't exist, which means big money stayed on the sidelines. But the real twist came when the barrier started to shift. Because if regulatory clarity actually comes into place, especially in the United States, that changes everything. Why? Because the U.S. sets the tone for global finance. When the U.S. moves, other countries follow. Now ask yourself this. If even a fraction of global finance begins moving on-chain, what does that mean for networks like XRP? Let's bring it back to the market. Every cycle follows the same pattern. Accumulation, expansion, distribution. Right now, XRP feels like it's still in that first phase, quiet, under the radar. This is where most people miss the opportunity, sadly, because accumulation never feels exciting. Smart investors understand this. They don't wait for confirmation. They build positions during uncertainty. They focus on structure, probability, alignment. Now, let's be clear. This is not about going all in. This is about risk management, discipline, long-term positioning, because nothing in this market is guaranteed. The only thing that's guaranteed in this lifetime is death and taxes, ladies and gentlemen, unfortunately. This is where a lot of people slip up. They chase gains, but ignore structure. They ignore platform risk, security, diversification. And that's where problems start. Same thing with taxes. Nobody talks about it, but it matters. Short-term trading creates constant taxable events. Long-term positioning, completely different structure. Let this sink in. But here's what really matters. This is not just about making money. This is about understanding a system that's evolving in real time. Because right now, we're witnessing a transition from chaos to clarity, speculation to adoption, noise to structure. And when you combine everything, regulatory movement, institutional positioning, market cycles, timing, signals, you start to see something forming, alignment. So let me ask you, are you watching price or are you watching the system behind it? Because if this continues, if clarity comes, if institutions may begin to participate more actively, if adoption expands, then this market could look completely different. And remember this, the market rewards patience, discipline, awareness, not emotion, not hype. That's how you get cut up like sushi. Short-term noise, long-term structure. If you made it this far, you already think completely different than most. So do me a favor, hit that like button, subscribe, and drop a comment. Are you positioning or waiting? Because the people who understand this are usually the ones who benefit from the next one. If you got value, hit the like button, subscribe, and share this with someone still stuck watching candles. Stay sharp, stay disciplined, stay Gucci, and don't get cut up like sushi. Sorry I wasn't able to drop any videos. I was away on business, visiting clients, family offices, but it's good to be here and be back. What an amazing time. What a really, we got a lot to go over right now, so buckle up, strap in, return to your seat. We're about to lose cabin pressure. And always, ladies and gentlemen, remember, one good tip from the pits can easily pay for your entire year subscription. If you want the deeper macro research and, more importantly, how to actually position around all of this, come and join over 500 active traders and investors inside the Crypto Republic Desk monthly. Welcome all our new members and membership channel. Ladies and gentlemen, if you've been paying attention to everything we've been saying, you got to understand that you are seeing what's happening. Everyone thinks oil is going down. That's a consensus. That's the narrative. That's what's priced in. And it's completely wrong. Because right now, the oil market's doing something it's never done before in modern history. Physical oil, real barrels, are trading $20 to $50 above future prices. Let me translate that. The real world is screaming, we don't have enough oil, while the financial market is pretending everything is fine. That disconnect, that's where the opportunity is. But more importantly, that's where the risk is. Again, what you're watching right now, paper versus reality, it's a split between two markets. Again, the paper market, the futures, traders, headlines, the physical market, ships, pipelines, actual energy flows, and they're all telling completely different stories. The market, the paper market, is pricing in a quick resolution, supply normalization, oil averaging around $90, $95 per barrel. But the physical market, it's behaving like we're already in a structural shortage. Why? Because inventories are collapsing. Global crude stocks are expected to drop by hundreds of millions of barrels, with OECD reserves alone projected to fall by 400 million barrels. That's not a small draw. That's a system being drained. Here's the real problem, the Hormuz collapse. Let's talk about the choke point. Nobody fully understands that the Strait of Hormuz, before this conflict, around 21 million barrels per day, roughly 20% of global oil consumption, flowed through that single corridor. Now, we're seeing disruptions in the range of 14 to 15 million barrels. That's not disruption. That's removal of supply. And here's where it gets dangerous. The market's currently pricing in an average supply loss of 3 million barrels per day for the year. But actual disruptions have already removed roughly 650 million barrels since the conflict began. That's so huge. You got to ask yourself, again, is the market underestimating or just hoping? There's a simple rule in energy markets, ladies and gentlemen, okay? Write this down. This is massive. Again, every 1 million barrel per day imbalance equals roughly $15 to $20 price move in oil. Now apply that. If supply is off by 3 million BD, $45 to $60 move. 5 million BD, potentially $75 to $100 move. And in the worst case scenario, we're talking 130 average oil. Potential spikes above $200 per barrel. That's not hyperbole. That's just arithmetic in this market. Again, ladies and gentlemen, here's where most people get this completely wrong and do get cut up like sushi. They think once the conflict ends, supply comes back instantly. It doesn't, because oil isn't a switch. It's infrastructure. And right now, thousands of wells are shut in. Some may require millions of dollars per well to restart. Refining capacity of at least 4 million barrels per day has been impacted. Even worse, shut wells degrade over time. Pressure drops. Pipes corrode. Restart complexity increases, meaning the longer this takes, the longer the recovery takes. It's rough. Let's simplify everything into one concept. Stay with me. Inventories are the buffer, and right now that buffer is disappearing. We're already seeing 110 million barrel drawdown in a single quarter. Strategic reserves being tapped. Countries like Japan and Australia seeing sharp inventory declines. They're getting crushed. Meanwhile, China's doing the opposite. They've been building inventories, plus 36 million barrels in a month. That's so huge. You got to really write that down if you can see this. It's crazy. Well, look at the transcript of the video. Restricting exports, protecting domestic supply. It's not random. That's strategic positioning. If supply doesn't come back fast enough, something has to give, and that something is demand. The projections already show demand reduction of 1.1 million barrels per day just to rebalance the system. How does that happen? Not gradually, not smoothly, through higher prices, slower growth, and in some regions, recessions, level demand destruction, especially in Europe, Japan, and emerging markets. The biggest mistake right now? Believing in speed. The markets assume 75% of supply comes back quickly. Full normalization happens in months, but the data suggests 6 to 9 months to return to 95% supply levels. And that's optimistic because we've seen this before. Red Sea disruptions lasted 28 plus months. So the real question is, are we pricing reality or pricing hope? This isn't just about oil, ladies and gentlemen. It's about everything connected. Inflation, transportation, supply chain, food prices, global growth, because energy isn't just another commodity. It's the base layer of the economy. And when that layer tightens, everything around it cracks. Most people will react to this late. They'll wait for headlines. They'll wait for confirmation. They'll wait for prices to already move. But by then, the position's already done. The smart capital is not reacting, it's preparing. And the only way to do that is consistently is to actively understand what the data is saying before the markets catch up, ladies and gentlemen. And this is what I'm always talking about. One good tip from the pits can easily pay for your entire year subscription. If you want the deeper macro research, and more importantly, how to actually position around this, come join over 500 active traders and investors inside the Crypto Republic desk monthly. Ladies and gentlemen, the disruptions that are coming from this are ridiculous. Ridiculous. And I got to say, ridiculous. Marinate on what I'm about to say, and I want you to understand how ridiculous the opportunities are right now to take advantage if you understand the data and how to apply it. The Nikkei hits an all-time high. Japan stopped publishing its oil inventories because in fear of setting off a panic. Japan imported an average 2.3 million BD. In April, it only imported 0.6 million BD. Deficit of 1.7 million BD. As of this moment in time, Japan has less than 30 million barrels in commercial crude storage. Japan released 80 million barrels from its SPR, 54 million barrels in crude. 84 million barrels in crude buys 49 days. Write this down. Japan will need to urge the IEA to do another batch SPR release. If not, it will unilaterally do it. It has 360 million barrels left, enough to buy it another 200 days. Ladies and gentlemen, that translates into such opportunities to take advantage of abnormalities in the market. You have no idea. I want to give a big shout out to Mike. I loved our conversation today. Me and Domenico love talking to you. Big shout out to Mike. Fantastic. Love talking with people. Love it. Love it. But here's the truth. And the truth of the matter is this. For longtime viewers of the channel, you love being a financial mercenary. You are gorging on the sushi. As the remora, we're loving this. The numbers I just went over, I get so excited, I don't even know what to say. It's everywhere. You got to understand something. There's a financial war going on right now, and it's changing the world as we know. The opportunities to prosper are right there. That's why I say, as a financial mercenary, we do this every day. We take advantage. I'm giving you the plays. I can't believe I give this away for free. But again, this Iran war isn't just about oil. It's about the metals that make the missiles. We're going to go over this, but you got to understand the crisis that's happening is crazy. Money is being rotated out of certain assets and accumulating others. It's I don't even know what to say. You got people getting cut up like sushi. You got people that just don't even know what's going on. And you know what the big thing why I'm so excited is why what I just read this, and I have a line I'm saying that we're getting killed by 1,000 financial headlines, death by 1,000 financial headlines. There's so many financial headlines coming out. It is creating arbitrage opportunities if you know where to look by taking advantage of the false narratives, the false news, the timing that the market takes from the false news, and the capturing of a profit of a trade closing out from the false move. It's ridiculous. I've never seen something like this in my entire career. Honestly. But the Hormuz blockade, China's discounted oil, and the tungsten, write this down. These are the next things that we're going after. And again, if you've been following everything I've been saying, from the nickel, the copper, LNG, you're so far ahead of the news because you're here hearing the narrative of what's happening. You're understanding how banks see this and what they take advantage of. Again, tungsten, write that down. The choke point colliding with Xi and Trump summit table. Ladies and gentlemen, the Strait of Hormuz sits at the center of both dependencies. 20% of all global trade crude transits. For China, it's the gateway through which Saudi, Iraqi, Emirati, Kuwaiti, and Iranian barrels all reach refineries. A U.S. naval blockade at Hormuz simultaneously cuts off Tehran's main revenue source and threatens a core artery of China's energy system. 2 leverage points apply with a single instrument. If you understand the who, the what, the where's, you understand how to take advantage of this. That's what it is. China's structural oil problem. Unlike the United States, which reshaped its energy balance through the shale revolution and now produces more crude and liquid than it imports, China is structurally short on oil and will remain so. China National Petroleum Corporate Research Division projects import dependency running at 70% throughout the current 5-year plan. In 2024, Chinese crude imports averaged approximately 11.1 million barrels per day, more than a fifth of all seaborne crude trade globally. Gulf producers and Iran collectively supplied over half those imports. Russia controlled around 20%. That concentration means Beijing is highly exposed to disruption in either the Persian Gulf or Russian export routes, and both are under active pressure simultaneously. Washington's approach to Venezuela crude over the past years offers a preview of the strategic thinking by Hormuz. Secretary of State Marco Rubio has framed Venezuela explicitly as China's oil base in the U.S. backyard. Ladies and gentlemen, this is my opinion, not financial advice. Anyone retains this in our capacity. Not financial advice, just my opinion. Noting that Beijing was receiving Venezuela barrels at discounts often without cash payments, structured instead as a debt repayment. Argument: taking control of Venezuela's oil sector was necessary to end arrangements that favored Beijing at the expense of ordinary Venezuelans. The volumes involved were modest, single-digit percentages of China's total crude imports, but the strategic logic was explicit. Reduce Beijing's access to deeply discounted barrels, make them pay in dollars. The Iran theater applies the same logic to a problem 4 times the size. Concentrated in a single choke point China cannot rewrite around. Again, China's counter layer, but you also got to understand something. The United States just signed a very good agreement with Indonesia about the Strait of Malacca. The Chinese were using underwater submersibles to try to map out that joint point because they're dependent on 40% of their sea cargo to go through this. Ladies and gentlemen, the financial war is on. The financial war is on. Operation American Energy, Operation Print It to Win It. These are all coming into play. But again, the things I'm rattling off right now, this is how you make money, by knowing what's going on. Not watching Netflix, watching this and getting excited. Again, China's counter level. China is structurally exposed on crude imports. It holds a dominant position in the critical minerals and the metals that Washington defense and high-tech manufacturing depend on, and controls not only the refining process, but also the supply control. Nowhere is that more dominance more concentrated than tungsten. Write that down. These are going to be the next massive plays and tips from the pit. Massive. China controls around 50% of the known global reserve and roughly 80% of annual mine production, approximately 67,000 tons out of global output to around 80,000 tons. More significantly, China accounts for over 80% of downstream processing capacity for ammonium parsacate, APT, and finished tungsten products. Western alternatives are thin. Australia, Austria, Spain, Portugal together produce only a few thousand tons per year. And many historic mines in North America and Europe closed decades ago under pressure from cheap Chinese supply. That long erosion of non-Chinese capacity is what turned tungsten from an industrial commodity into a strategic vulnerability. Beijing turns the valve. This is so important, ladies and gentlemen. Starting in February 2025, China moved from passive dominance to active enforcement. The Ministry of Commerce imposed export controls on 41 tungsten-related products, codes, including APT and a range of semi-finished products under its export control law. Over 2025, Chinese tungsten reports fell roughly 40%. New rules for 2026, 2027 restricted outbound shipments, further limiting exports to a short white list of approved exporters operating within the tight historical volume quota. By early 2026, the effect was visible. In custom data, Chinese APT exports fell to effectively zero. In January and February, even as imports of tungsten concentrates rose sharply, during China into a net importer of tungsten for the first time in its modern industrial history. Let this sink in. This opportunity is so massive, it's crazy. Domestic concentrate prices rose. The export data provided by Trade Data Monitor shows both the scale of restriction and its deliberately selective application. The United States saw exports drop 94.8%. Vietnam fell 90.4%. Meanwhile, the United Kingdom, a country with minimal domestic tungsten using industry, saw export rise to 172.6%, suggesting rerouting through intermediaries. That's massive, that number. Write that down. Thailand tells a similar story. Japan, South Korea together now account for nearly half of all Chinese tungsten exports. Professional access that Beijing has used in other commodity controls to reward allies and penalize adversaries. The pattern is not random. It's policy. Come on, guys. The data above maps the pressure. If you write down what I just said, it shows on both sides the naval blockade, the discounted battles, the leverage at Hormuz, the metal that makes the weapons, ladies and gentlemen. Tungsten is not glamorous. It does not have lithium electrical vehicle narrative or uranium geopolitical mystique. It's dense. It's boring. It's like watching paint dry on the wall. Get excited because it can make your bank account grow through proper tips from the pits, allocations, and strict money management. Gray metal found in a small number of hard rock deposits. None of this is financial advice, just my opinion. And it spent most of its industrial history as a background inputting and cutting tools and drills. Notice only when it ran in short. What makes it strategically irreplaceable, and this is why the trades are going to be so profitable, in my opinion, not financial advice. What makes it strategically irreplaceable is a combination of physical properties that no other material currently matches. The highest melting point of any element, extreme hardness, density, and near-perfect dimensional stability under thermal shock. These virtues explain why tungsten carbide, the compound formed by binding tungsten and cobalt, accounts for roughly 60% of all tungsten consumed globally each year. Sedimented carbines are the cutting inserts, drill bits, milling tools. They're the machine components going into aircraft structures, turbine engines, or motor parts, and mining equipment. Without a reliable supply of tungsten cartridge tools, industrial throughput falls apart long before factories run out of steel or aluminum to process. Nobody talks about this because this is like watching paint dry on the wall. The metal is embedded deep in the production function of modern manufacturing, invisible until it disappears. Defense applications make this vulnerability acute. Tungsten appears in kinetic penetrators that punch through armor, in the counterweights and imbalance of components of guided munitions, in X-ray tubes, welding electrodes, and in tungsten helifluoride, used as a precursor gas in semiconductor fabrication. Jet engines require tungsten, bearing superalloy coating on turbine blades, that cutting tools that machine those blades run on tungsten carbide. There is almost, again, no path for raw metal or materials to finish weapon platform that does not touch tungsten at multiple points. You got to let that sink in. That's massive. And if you think about the munitions that were just spent fighting these wars, the metal does not just go into weapons. It goes into the factories that build them. Why recycling won't buffer this shock? Tungsten circular economy is real. Global recycling provides 25 to 35% of total supply. And in closed industrial systems, where scrap carbide tooling is easy to collect and reprocess recovery, rates run considerably higher. Normal times, this buffer matters and takes the edge off primary supply squeeze, and has historically prevented short-term shortages from becoming critical. The Iran conflict has exposed the hard limit in that model that any peacetime analysis missed. A growing, accelerating share of current tungsten demand is going into use where the metal is permanently destroyed. Armor-piercing rounds, artillery shells, missile guidance components do not return. They're scattered across impact zones dispersed on the seabed or lost in contested territory that no logistic chain can reach. Every missile fired over Iran is burning through finite tungsten stocks with no possibility of reclamation. As military consumption scales, driven by the Iran campaign, NATO rearmament budgets that have doubled in several member states, and parallel defense buildouts in South Korea, Japan, and Taiwan, the share of tungsten goes into terminal uses raises structurally. And even recycling technology continues to improve, the recoverable scrap pool contracts relative to total demand. The buffer that worked in peacetime does not scale with the war. Simultaneously, wartime disruptions to European industrial production has slowed the practical collection of processing of secondary metals. Any supply accuracy model built on pre-2025 recycling assumptions, structurally wrong for this. So when you look at this, the United States, European Union, they've moved to concern regulation. It's unbelievable. There's not enough of this. So understand this, right? The United States and the European Union have moved from concern to regulation. That's big. We went over what happens with regulation, what happens in prices of metals when they're put on lists. The jump's crazy. The deadlines are now concrete, enough to drive purchasing decisions today. The pivotal U.S. date is January 1st, 2027. Under updated DFARS clause, 252.225-7052, the Pentagon will be barred from procuring tungsten powders and heavy alloys of any stage of their production, including mining, refining, separation, melting, or fabrication occurred in China, Russia, Iran, and North Korea. You have it right there, ladies and gentlemen. What a long time out of control, amazing play this is going to be. The clause closes a loophole that previously allowed Chinese processed tungsten oxide or powders to pass through third country facilities and enter U.S. defense supply chains as a clean product. Traceable now runs all the way back to the mine. That's very big. We see it every day when you're bagging and tagging, something comes out of the ground. You gotta trace it all the way back to where it came out of the ground. Only commercially off-the-shelf items containing less than 50% covered material by weight retain a narrow exemption. So for prime contractors, they're tier 2 suppliers. This is not a soft guideline or aspirational target. Non-compliance can lead to contract termination given the rearmament's already driven. It's unbelievable what happens with this. So when you see where this is going to go, if you look at numbers, right, even with the EU's Critical Materials Act applies parallel pressure. Tungsten is only one of 17 commodities classified as both critical and strategic, the highest designation Brussels uses by 2030. Benchmarks require at least 10% of annual EU tungsten consumption. To combat for domestic extraction, at least 40% of processing to occur with the block. Currently, the EU covers only about 21% of tungsten needs. Extraction stage remains roughly 80%. So the gap between regulatory target and current realities is massive. Ladies and gentlemen, that's so big what I just went over. You realize how big that is? It's massive. They control all of that market. Now, there's a rush to get it from a friendly market. That's why I say the chaos that's been created from this war is causing people who are taking advantage of the disruption of supply chains into new supply chains. The ability to make alpha off that is out of control. Ladies and gentlemen, if you want to know how to take advantage of this, do come and join us in the Crypto Republic Desk monthly. I always say, one tip from the pits will easily pay for your entire year subscription. But more than that, you can use the alpha you make from trades to acquire other assets. That is what the banks do. The banks take advantage of these trading opportunities and they build positions by rotating capital into other sectors. That's why we're the remora. That's why being a financial mercenary, you hone in on what to do each day with this. There's something else that I want to talk about. Ladies and gentlemen, I'm paying attention to this, and there's a $1,300 spread in this. Ladies and gentlemen, 4 or 5 major supermarkets in South Korea sold out of waste disposable bags by March 24th. Taiwan's Costco stores imposed purchase limits on plastic wrap and containers. South Korea's government designed 7 petrochemical feedstock items as crisis items under their Supply Chain Stabilization Act, a law most Koreans didn't know existed until their trash bags disappeared. The commodity behind it isn't oil, it's polyethylene. The plastic in the bags underneath your sink, the lining inside your cereal box, the caps on your water bottles, the most produced polymer on Earth. About a fifth of the world's capacity to make it has physically shut down. Another chunk is running at emergency minimums. The effect output's lost, it's crazy. I'm watching one chart, okay, for 5 weeks. It's not Brent. Everyone loves Brent. No, not the tanker queue, 430 ships and counting. No, sitting in the Gulf. I'm watching. It's not the ceasefire, which collapsed on April 12th, roughly 4 days after the market celebrated. The chart is the U.S.-Asia polythene spread. In February, it was around 500. Today, it's 1,300. It's a metric ton. It's boring. It's watching this. But you know what? It's the kind of number that lives in the corner of a commodity desk. And it never makes it onto CNBC. You'll hear it right here at the Crypto Republic, and you're going to hear about it in the Crypto Republic Desk Monthly, baby. As of late of March, it blew past $1,200. Oil gets the Bloomberg real estate, the Goldman notes, woo, cable news Sharons. The real story is underneath a petrochemical feedstock choke point that is already showing up on shelves in Seoul, while American analysts are still arguing about Brent. And this crypto coin sucks. No, oh my God. Oh my God, did not take advantage of what's happening? That's oh my God. And the part that really has my attention isn't the shortage. Shortages end up. What I'm watching is the crackers that have shut down and whether any of them are going to come back on, ladies and gentlemen. And I want you to understand something. The people that understand, well, the people who take the time to actually understand what's happening underneath are the same ones who are positioned before the next move begins. Because by the time it's obvious, it's already too late. Ladies and gentlemen, if you want to stay ahead of how this evolves, this is exactly what we're tracking inside the Crypto Republic Desk Monthly. Real-time shifts, positioning, how to navigate it as it unfolds. The goal isn't to react. The goal is to be positioned before the move. And as always, one good tip from the pick can easily pay for your entire year subscription. You want the macro research, the deeper, learn how to take advantage of all this, come and join over 500 active traders invested inside the Crypto Republic Patreon. The other things, ladies and gentlemen, I like. We went over this last video. China's banning sulfuric acid, copper, uranium, nickel. The plays, besides the actual commodities, are going to be so big for the amount of that you need to do. It's unbelievable. And why I say this, it's unbelievable. Again, there's so much shortages for what's happening in the war. China's just indicated that it will hold exports of sulfuric acid starting May 2026. Well, this might sound like an obscure industrial headline. It's actually a massive supply chain shock that's about to ripple through the global commodities market. Sulfuric acid is a critical reagent required for hydrometallic mining process, specifically the leaching of copper, uranium, and nickel ores. Without it, you cannot extract the metal. China is one of the world's largest exporters of byproduct sulfuric acid. Removing that supply from the global market guarantees a severe cost spike for miners relying on reagents. This export halt is hitting a market that's already incredibly tight. Global sulfur prices have surged 70%. 70%! Recently due to disruptions in the Strait, and now the primary chemical derivative is being restricted by the world's dominant supplier. This impact will be immediate, highly localized. Operations in Chile, the Democratic Republic of Congo, Zambia, Namibia. They rely heavily on imported Chinese acid for their heap leaching. Solvent extraction processes are about to see their operation and expenses explode. This will inevitably lead to production curtailments, delaying expansion and tightening of global copper, uranium supplies. Ladies and gentlemen, by China cutting this off, you're going to look at a copper squeeze. Heap leaching requires 3 to 3.5 tons of acid per ton of copper cathodes. Chile alone imports over 1 million tons of Chinese acid annually to support 20% of its natural output. Uranium impact conventional acid leaching is the standard for uranium extraction. So operations in Namibia, Kazakhstan will face immediate margin pressure. Ladies and gentlemen, I want you to understand something. The war going on right now is going to lead to printed to win it. Operation American Energy. Printed to win it's the way the American financial system prints it out of this scenario. Why? When longtime viewers and readers of the Patreon and listeners of the channel, when we had the map up, the East and West tranche, the war's going on. And if you could go all the way back to when we said about what was going to happen to Venezuela before Venezuela happened, what happened to the Middle East before it happened, where this is the next stop on that train of collecting alpha and harvesting alpha for our crop rotation of farming alpha. Ladies and gentlemen, there's going to be shortages. There's going to be shortages in everything. It's coming. So all these obscure facts I'm talking about is where the smart money, hedge funds are going, family offices are going. Everyone's getting involved now. So everyone always talks about the sexy stories online. The boring stories sometimes make you the most alpha. But I tell you this all the time. Again, if you want to stay ahead of this evolving, come and join us in the Crypto Republic Desk monthly. Join over 500 active traders and investors. See how one tips from the pits can pay for your entire year subscription. Take your game up a notch. And ladies and gentlemen, I had a lot more to go on. I just can't keep going on with everything today. The real thing from this is, again, you're seeing banks rotate out of gold now into Bitcoin. Citibank's one of my favorite places to read when they have the material that come out. Their institutional reports are unbelievable. Again, unbelievable. And they're telling people to rotate some out of gold back into Bitcoin. They're the ones when we told you about gold dropping, we agreed with them. Okay, when it first fell. There's so much happening right now. There's so many places to take advantage of. It's unbelievable. You know, from my viewpoint, I'm seeing a clear emergence of institutional interest in Bitcoin. It's not happening in a vacuum. The timing is directly tied to recent behavior in the gold market. During the last pullback in gold, Bitcoin remained relatively stable. That alone is enough for banks to begin reaffirming the narrative. What I'm hearing now, particularly from more sophisticated desks, not financial advice, just my own opinion. None of this is financial advice, just my opinion. So the argument that Bitcoin may serve as a complementary or in some cases alternative hedge to gold. The justification being floated centers around macro conditions such as yield curve dynamics, specifically in an environment where the yield curve steepens. There's a growing view that gold may underperform while Bitcoin has shown some resilience. To be clear, I'm not endorsing the conclusion. I'm simply pointing out that this is the direction institutional messaging is coming from. The more strategic players are already positioning in this idea. They're telling clients, rather than maintain full exposure to gold, consider reallocating a portion into Bitcoin. The reasoning is straightforward. Bitcoin held its ground during a period when gold did not. However, there are important counterarguments that need to be acknowledged. Again, ladies and gentlemen, this is what people are saying. Again, this is not financial advice, just my opinion, what people are saying on the street. You understand me? This is what people are talking about. And you got to understand something, right? They rotate assets into one place into another. That's what funds and hedge funds and family offices do as well. They're going to do that all along. And I want you to understand something, right? I love reading bank reports when they come out. I read every one of them. I know who's good at what. It's like when I'm on the floor of the Mercantile Exchange. You learn to track who's good and who's not. And ladies and gentlemen, we put out an article that talked about how the United States is now the leader in crypto, the crypto capital of the world. You believe in this administration right now in POTUS, you believe in Bitcoin over anything else. In 5 years, metals are going to be much higher because they're going to revalue higher regardless, right? But you take advantage of the day-to-day noise. You take advantage of all the noise that's going on. You take advantage. Look where oil is. Oil around $100, dropping down. You look at where all these things are going, and it's unbelievable. Like oil right now at $90. Let's take a look right now. $90, okay? Silver around $78. Gold doing its thing. Do you understand that they're rotating out of assets for better volatility? Print it to win, it's going to begin faster than not. And when that begins, you're going to wish people had access to more things. That's just what it is. Again, ladies and gentlemen, what a time to be alive. And as financial mercenaries, you take advantage of all of these things. You take advantage of the daily chaos. We're living through the daily chaos now. There's nothing that we can do about it. The price of food, cattle's going through the roof. That was a sick trade, cattle. You better stock up on steaks right now if you're going to, if that's your thing, or vegan-ness if that's your thing, whatever it is, if that's your thing. Because when the grilling season starts, look out. But this is what's happening, and this is what we have to live through, ladies and gentlemen. Again, I track all these things because it's what makes us money. It's why people retain us in any capacity to find these opportunities about things and go with it. But that's why we risk it all the time, risking my reputation every day with this. Again, ladies and gentlemen, this content's for informational, educational purposes only. It should not be taken as financial advice. Always do your own research and consult a licensed financial advisor before making any investment decisions, always. Remember, the game is changing, and those who understand it first will benefit. Make sure you're on the right side of it. You have two choices. You can be like the crowd reacting after the move, rationalizing why they missed it, telling themselves to never let it happen again, or you can be the one who saw behind the curtain, the one who understood the infrastructure shift, the one who positioned early, not randomly, but intentionally. Because some moments in history are loud, the ones that change everything are quiet, right up until the moment they're not. And this is one of those moments. Do not blink because the world is distracting with noise while XRP continues developing behind the scenes and building momentum in their broader digital asset landscape. Stay sharp, stay informed, accumulate knowledge. Your move now will be remembered. It's not the end of the story. This is just the beginning. If this opened your eyes, smash that like button, ring the bell, leave a comment with your thoughts. Turn on notifications, and most importantly, subscribe to Crypto Republic, where we break down the major global banking trend shaping assets today, giving you context, clarity, and research you can use. Don't just watch history happen. Stay informed, stay ahead, stay in the Republic. I love you all. I'll see you on the front lines.